Hey, Bowtie Nation, Joseph Hoke here. Thanks for tuning in to the first of these, hopefully many of these beer money lives. I love doing these live chats with you. Those of you in the community for a while know we've done these in the past. It's just a great opportunity to get that conversation going, kind of highlight some of the comments we've received last week, study a topic, and really, answer some of your questions. So I love doing this. Hopefully, do this much more often. Sundays, see people filling up the chat here. Welcome. Thanks for being here. Mary Saints is here from. I am going to have something. So want to get started here. Got a lot of great stuff planned for you today, and we're going to get started. Yeah. I'm ready. Video is definitely not sponsored by, but that would be cool if we could hook that up someday. What we're going to do today is highlight a few of your comments, your questions I've gotten over the last week. I love the feedback and the questions and the conversation we get in the comments below the videos, as well as on our private Facebook group. Let's Talk Money Together. I'm going to show you how to join that in a little bit. But I love the conversation we have, and I wanted to highlight some of the comments from you out there in the nation. Today's topic, we're actually going to talk about some COVID vaccine stocks. Got a lot of questions so far over the past few weeks. These are really, really shooting higher, and I think there's some opportunities there, but also a lot of risks. A lot of the big name COVID vaccine stocks might not turn out to be all you expect them. And then, of course, we're going to spend time with some Q&A here. Welcome, everybody. Looks like Freebird from New York State. David's in here from Columbia, Missouri. We got an OC from Mark. Thank you for being here. Yep, the no bow tie today. These Sunday live streams, I mean, like I said, I love doing them just to get the conversation going, see you out there in the community. But it gives me a chance to take off the tie and, have a beer or a drink, any kind of a drink with all you out there in the nation, my favorite people in the world. So let's get started here. And again, we're going to do that Q&A after we talk about those COVID vaccine stocks. So, feel free to put your questions in there. If I don't see your question, please ask it when we start that Q&A section, and I'll make sure to get to it. So we're going to get started. And our first comments came from last week. We had Zach and Justin actually were asking about pipeline stocks. So I want to bring up their comments because they were great comments, great questions. And I wanted to highlight those. Zach wanted to know about pipeline stocks, Kinder Morgan, Energy Transfer, Enterprise, and then Justin there on the Facebook group. So if you're not a member there yet, it's totally free. It's just a great conversation starter there on Facebook. It's our private group. Let's Talk Money Together. I've got a link in the video description below, or you can just go to Facebook and look for Let's Talk Money. Just a great way to back and forth conversation. Really hard to have a back and forth conversation here on YouTube in the comments. So that's why I created that group. It's almost 10,000 people. So I love seeing that. Love seeing the conversations we get going there every day. But, Justin had in the group had a related question to that, thoughts on PAA, which is another pipeline stock. He was in at 9, started dollar cost averaging down. He's starting to rethink his investment in it because, honestly, the pipeline stocks and the whole energy sector haven't done much over the last, really since 2014 almost, when the prices came down from $100 per barrel crude, and then especially this year when we had that huge demand hit because of the pandemic, because of the virus. And prices went negative for briefly there and have really stagnated around $40 a barrel. So I wanted to talk about pipeline stocks real quick, answer these questions. Great questions, by the way. And, those of you in the nation that have been watching for a while, I like a lot of these pipeline stocks, the fund. I'm actually an AMLP, which is the Alarian MLP fund. Gives you an opportunity to own these stocks without getting that K1 form, which is kind of an annoying little tax form you get every year if you own these MLP stocks individually. Now, I do like the MLP stocks, though, even with that K1 form, because, it's really not that hard once you figure out how to add that to your taxes, and they give you some great benefits. You actually don't pay taxes on most of your dividends you get from MLPs. Okay, you don't pay taxes like other dividends in the year that you receive them. You actually just take them off your cost basis, and then eventually when you sell that MLP, then you take it off. But the beauty of it is if you hold that MLP forever and it gets passed down to your heirs through an estate, then the basis gets marked up. So nobody ever pays taxes on usually about 80% of the dividends you collect from those MLPs. So it's a great way to invest in cash flow investments in stocks and MLPs without those taxes. But again, over this last year, or especially a year, but even the last 5 or 6 years, even MLPs have suffered because those that fall in energy demand and in oil prices. But right here, I do like them, KMI, and even, what you got to do, you look at it, and I know a lot of people, they look at the return on these investments, the price return over the past 5 years, even over the past few years, and it's negative. But when you add in those high dividends, because a lot of these stocks pay dividends of 8 and 10% and even higher, then when you add in the money you made on the dividends, then it's pretty well a wash. And I think there's a lot of value wrapped up in these stocks if you can invest now. So I do like a few. PAA is a real good one. I like the larger MLPs just because they've got that size, the scale to survive this. Right now the lower demand and the lower demand for the pipelines. So I do like the larger ones like PAA. Kinder Morgan is a really good one, and I think they actually converted from an MLP to a regular corporation last year. So you won't get that K1 form. You'll get the higher dividends. It's about an 8% yield. And the average analyst estimate is around 1760 for that stock, that KMI, which is about 32% higher, plus that 8% yield. The co-founder over the last year has bought 1.7 million shares. So definitely he's going all in on this company. He owns 11% of the company. So it's definitely a vote of confidence for that. Like I said, I also own the AMLP, which is the fund, which gives you a nice diversified basket of a lot of these MLPs. It doesn't send you out the K1 form, but I also own some of the larger MLPs individually as well as. So we'll say PAA, I own KMI, and I own ET, which is Energy Transfer. Now, as far as part of Justin's comment is, how big of a position should he have? He's been dollar cost averaging into this, and he's starting to worry about how much money he has in this. And for those of you in the nation know, this is a lot of what we talk about sometimes is how much you have in any singular stock. I know a lot of you love Apple, you love Amazon or Tesla, and they've been great investments over the past year, but what happens when they aren't? Okay, every investment works until it doesn't, right? I always recommend never having more than 5, maybe even 10% at the most of your money in one single stock. Okay, GE was a great company until it wasn't. BlackBerry, Research in Motion was a great company until it wasn't. And ask anybody that had 20 or 30% of their money in one of those two stocks, really believed in the company. Or Enron, another seemingly great company, strong company. Ask anyone that had 20 or 30% of their money in any of those single stocks what they think you should have in any single company. So definitely, I know you get wrapped up in a company and a stock, great returns when they last, and you start buying in, you keep buying in, but watch that position. Watch no more than 5, 10%, even 10% of your money. If that stock loses half of its value, like a lot of these other stocks have on occasion, if you've got 10% of your money, you just lost 5% of your total wealth. Okay, so it's very hard to come back from something like that, especially if you kind of panic and sell out at the bottom and basically realize those losses. So those great questions. Thank you again from Zach and Justin. I'm going to do one more question here about that I got on. In the Facebook group. Again, is a question from Gorev Singh on Dropbox. And Dropbox is one I hadn't looked at for a while. I actually use Dropbox. I don't pay for the subscription, but I use the free service. But it's really interesting to me here. It's kind of surprised to see that the chart on Dropbox hasn't really done much this year. Even despite the fact that they just blew away second quarter earnings. So let's look at this real quick. Dropbox, so ticker DBX there. And like I said, it's kind of surprising for a company that basically what Dropbox does. They're a cloud storage company, so you can you pay a subscription, so a monthly fee to be able to store your files on Dropbox. You can you can send your files and collaborate on your files with coworkers and that kind of thing. So it's kind of surprising that something like demand is rising so quickly in that theme that the stock really hasn't done much for the past year here. Pretty much flat for over the past year. Over the past 5 years is done well. Not 5 years. They just went public. It looks like in 2018, down from $30, $31 a share on the IPO. So it's really been a losing bet, despite the fact that they blew away their second quarter earnings by 29%, even beyond a history that management has of beating expectations. So I definitely think there is some value in this stock. Just the direction that remote work is going, that work from home is going. The financials look really good here. There are a few things that the group pointed out in our group chat on Facebook on there. It's kind of a one-trick pony at this point, right? They've got that great file sharing and file storage system, but they don't have a lot of the other tools that maybe like a Google Drive has, or some of the other collaboration stuff that maybe Microsoft has. Small company, $8 billion, which is relatively small in the market right now. But they are recently trying to move into more of that content collaboration idea. And like I said, I think there could be some potential here. It is very, very well priced. There's a good value relative to a lot of these other, work from home, remote work themed stocks, right? And just as standalone growth. So if they can get that content collaboration, get in with more companies to use the Dropbox, their storage and collaboration file storage kind of thing, or really as an acquisition play. I think this is probably one of my favorite acquisition plays, because they've got something like 500 million customers or something using Dropbox. So they've got the scale in this file storage and content collaboration theme, which is huge right now, obviously. And as we shift to that work from home environment, they've got that set up. And that would be just a gold. They've got a lot of the data there. That would be gold for any company that wants to move into the theme immediately, be able to add on. And like I said, relatively cheap here, $8 billion company. The price to sales is relatively cheap against some of these other like Zoom and some of these other work from home theme stocks. So another great question. Thank you for that. Again, if you're not part of our group there on Facebook, just look for the Let's Talk Money Together group there on Facebook, or there's a link there in the video description. But now I want to get to just kind of highlight last week's videos, next week's videos, and then we'll get to those COVID vaccine stocks that we're talking about. Last week we started a daily dividend portfolio, and I'm really excited about this one. Really excited about this series that we're doing. It's going to be about 60 stocks, right, that will pay you a dividend every single day of the week, every work day of the week, 5 days a week, 51 weeks out of the year. 52, but of course you won't be getting them on holidays. And how this works is that every quarterly dividend stock pays out 4 times a year, right? So all you need to do, and it's extremely consistent schedules, right? Investors love that stability and that consistency in dividends. So the board of directors likes to declare, go ex-dividend, and pay those dividends on the same day, each quarter. So what you can do is you could look for, each month you look at the ex-dividend dates and basically just pick out, stocks for each day that are going to go ex-dividend, and then of course they'll pay their dividend in a week or two after that. So I just started that this last week. Great video, and we're going to be doing 2 more videos to fill out that portfolio. But I have some questions about videos, and I love exploring and researching different themes. that doesn't mean you don't need to invest in every stock we talk about on the channel, right? And I think this is very important because I think a lot of people are getting kind of overwhelmed with all these stock picks and themes and stuff. You know, as an analyst, my job was to find these different themes to bring these research ideas and these investment ideas to my companies, to my bosses, either venture capital or when I worked with private wealth, and just to just to be a source, a resource of investment ideas. I love doing it. But again, you don't need to jump into every single one of these. Okay, what you do is you watch the videos, and one video might be okay, COVID vaccine testing stocks, and you look at it, you listen to the argument, which stocks that I'm recommending, which stocks you're thinking about. And you look at your portfolio, tech stocks in your portfolio. So if I come out with 5 tech stocks to buy video, then okay, maybe I do need a few more tech stocks in my portfolio. So I watch that of the 5, maybe I pick out one and invest in that. But just don't think that you need to invest in every stock we highlight on the channel. It'd just be overwhelming. You would never be able to keep up with those stocks because remember, I mean, every stock you hold, you should be doing some quarterly research, just keeping up with the news, looking at their financial statements that they release on their quarterly earnings, that kind of thing, just to make sure that it's still a good investment and still appropriate for your portfolio. So yeah, don't feel like you need to jump into every stock that we talk about. Next week's videos, we got one coming up tomorrow for dividend growth stocks, and I'm going to kind of change up the definition of dividend growth here. It's going to be real fun. It's going to be not only dividend or companies that are growing their dividends consistently, which is usually pretty much the sole definition of dividend growth stocks that you hear, but I'm looking for companies that are also growing, their sales, their earnings. They have great cash availability, so they're not only growing their dividends, but they're growing those fundamentals as well. So we're going to be looking at those tomorrow. Friday, we got some money predictions, kind of a fun video that I put together on 5 predictions for finances, for money over the next 5 or 10 years. And I love this type of theme investing because these are broad, universal forces that are driving the world economy, the global economy, and are really going to drive stocks. So when you invest in these themes, you don't necessarily even have to pick the best stock of the best in the group. You just have to be tuned in with that group, with that theme, and ride that all the way higher, because those themes, those universal themes, are going to be pushing every stock in the group there. Good. Okay, so I see a few sponsorships here. I can't remember what you call them, but Lakidu, thank you very much. $2 there. Lawful, $10. Thank you very much. If you have any questions, let me know there. Lakidu wants to know if Snapchat is going out Monday. I can't tell you from day to day. If you saw the Snapchat video we did, I think it was last week or the week before. It's one of the few social media stocks I really like right now. It's got the fundamentals are a little stretched right now, the pricing, the valuation, but I've seen some data, some background data on the platform that's really makes me think it's going to be one of the heavy performers. They haven't quite figured out how to monetize the platform quite as well, which actually kind of reminds me a lot about Facebook. When Facebook first went IPO, in I think it was actually November. By March, the shares were down, from I think of like $42 where it ended on its IPO day, down to about $18 a share by March of the next year. So straight downward. They weren't monetizing very well, and look at what Facebook has done since in the 4 or 5 years since. Something like 40, 50 times your money. So when these platforms figure out how to monetize their growth, I think they do. They're going to do really well. Snapchat, like we pointed out in the video, it's got some great plans coming up for expanding on that growth, and it's got one of the best demographic niches that I've seen in any social platform. Within that Gen Z segment that is just growing into their earning years, they are bar one, number one. So I do like Snapchat over the long term. Those with the options, with the call spreads or the bullish options and the calls, you got to be careful there, because you're also looking at the broader market there. as much as I like Snapchat, if the broader market comes down 10% over that period of when you've got that call option on, it's going to weigh on Snapchat as well. So you've also got to worry about the broader market. So that's next week's videos. Be sure to tune into those. And now I want to get to today's topic, today's theme, and then we'll do some Q&A afterwards. Just real quick though, I wanted to talk about the vaccine stocks because getting a lot of interest in these, getting a lot of people talking about these over the last couple of weeks as the government starts to talk more about the vaccines. As you know, we know quite a few of these vaccines are in the final phase 3 testing of that. So I kind of wanted to give you an update of where we're at with these vaccine testing, the stocks involved, which ones to invest in, which ones to watch. Okay, so right now we have 3 companies that are in phase 3 testing of the coronavirus vaccine, and I want you to understand it's not necessarily who is first to get approval for their vaccine, or anything like that. I do think there's going to be some trading opportunities depending on who gets first to market and otherwise. But just in the U.S. alone, we got 330 million people in the U.S. It's estimated that because most of these vaccines, even the flu vaccine you take only has an efficacy of maybe around 50, 60, 70%, which means that, out of 100 people that get the flu vaccine, it's only effective at stopping the flu for maybe, 60 of them. Right? Only 60 of them build up those antibodies, those immunities to the flu that year. And that's what they're predicting for the coronavirus vaccine when it comes out and for these different companies. So, if it's 50% efficacy on this vaccine, then you need 2 shots to have a good chance. Then it's still not 100% chance that you're going to be immune to the virus. But so they're saying that any vaccine, you're going to have to get 2 shots. So 330 million people in the U.S. alone, that's 660 million doses of this that we're going to need to crank out. No one company can do that, right? And especially not in the time frame we're talking about. So a lot of these companies, even if they're not first to market, if they can come out with a reliable and effective vaccine, they're still going to benefit. And so think about that. You don't need to necessarily pick one single pharmaceutical biotech stock to win out on that. So like I said, there's 3 companies right now. Moderna, ticker mRNA, is the most talked about. They were really the first to start some of those trials. But and I guarantee you, the longer this live stream goes, the more I drink, the more interesting the conversation is going to get. So stay tuned for that. So now the thing is with Moderna, and we're going to look at some fundamentals here pretty soon, is that it's been bid up so much, and it's such a small company. They've had the slower infection rates in the United States over the last few weeks means that there's slower phase 3 signups and the trial. That's one of the news I just saw this week for Moderna. The CEO came out and said his best plan is for October, but he thinks it's unlikely but possible. Okay, and it's important. We're going to talk about this. I think he's managing expectations here. Every company, especially before the earnings release, they have to manage those expectations for earnings so they can beat the earnings and look like management's doing a good job in earning those millions of dollars. But I think he's managing expectations here because when he said his best plan is for October, but it's unlikely. He also said in another commentary I saw, he said the plan was, or the strategy was, not to be first, but to be the best. Okay, so he is definitely managing expectations. So if one of these other companies comes out first with with data on their phase 3 trials, then everybody's going to just dump Moderna and stop talking about them, all that kind of thing. He's still hopeful, I'm sure, that they can get the phase 3 data done and to the FDA first, but he's trying to say, okay, you know what? Maybe we don't, maybe we do. But yeah, the slower infection rates in the U.S. is meaning a slower phase 3 signups for the company. So I wouldn't expect them to be to be first. Pfizer BioNTech timeline is actually looking a little bit faster, and the key data on their phase 3 trial is expected end of October. Again, as we've seen with these other two, with Moderna and Astrazeneca, which we'll talk about, that phase 3 data can get pushed back a little bit. Trials can get paused. So, but as of this point, Pfizer looks like it's probably in the lead right now for key data from their phase 3 trials and for approval by the FDA. AstraZeneca, a lot of you saw, had its trial paused in the U.S. after an illness from one of the candidates. They're saying that maybe that illness wasn't related to the vaccine, but of course, anytime you're talking about these vaccines, you have to, you have to be extremely cautious. There's been history is replete with these times where they tried to rush out vaccines to different virus, and people got sick. A lot of people got sick. So they have to be very careful here. The U.S. trial, the trial in the U.S. for AstraZeneca is still paused on that. I think it's still going, continuing elsewhere in the U.K. and in other regions. So those are basically the three companies that are in the lead right now. Now, what you can do, and something I've been using over the past few weeks, I really like this stockcard.io. I've got a link in the video description below and in the comments there. And one of the features I really like here is if you go to the Discover tab up on the top menu and then to Featured, they actually kind of highlight some of these themes. So you've got a COVID-19 testing kit, 79 stocks in that theme, electric vehicles. Here are the COVID-19 vaccine race, 66 companies. So you can kind of look through here. And it's just a great way to kind of start your research and look at some of these. They've got Moderna here. And part of the reason why I really like StockCard is that it incorporates a lot of the ratios and the analysis that we talk about on the channel. The analysis I spent the last 20 years learning through CFA, through working with venture capital and private wealth, and they boil it down into a little bit easier to understand levels. So so you can go through here, and what they do is they boil it down into these cards. Okay, so if you got operations, you can see here sales growth. Okay, so sales growth is made up of these six fundamentals: quarterly revenue growth, 3-year revenue growth, fiscal year growth, the trend, that kind of thing. And they boil that down into kind of a stop sign approach, right? Green, yellow, and red. Some of these other here, profitability, you can get EPS growth. You get cash availability, current ratio, quick ratio. So it's an easy way to be able to get all your research done for you on that. So just go to Discover and the Featured tab, and you can look at a lot of these themes, right? And we'll actually be highlighting another theme, those dividend growth stocks, tomorrow in our video, and I'll be sharing a screener that I set up here on StockCard. But when you're looking at which of these to invest in, these COVID vaccine stocks, I wanted to point out some stuff what I'm looking at for these particularly these three companies. If we go back to Yahoo Finance here, and I'm using Yahoo Finance because I want to see kind of the stock trend and some of that historical data or the statistics they have on it to kind of compare where they're at. Okay, so if you go to we're still on Dropbox here, so we'll go to Moderna, and you look at this. I mean, the stock has just really taken off, right, on that COVID vaccine. You go to the statistics; it's a $27 billion company, so not small, but you go to these statistics and you see, price to sales 224 times compared to just last year before this whole outbreak happened. 50 times, 40 times price to sales. So it is trading for, 4, maybe even 5 times where it was just last year on that price to sales ratio, 9 times price to book value. It's a little bit more than half of where it was trading there. So it's definitely, benefiting from this COVID vaccine theme. And you go through here. Okay, it's got a fairly nice balance sheet actually. It's got $2.7 billion in cash on the balance sheet and only $171 million in debt. So it's a very much cash positive balance sheet, which obviously is important for these biotech companies because they're developing a vaccine or developing these drugs, and it could be years before from development, from R&D to actual sale of the vaccine or distribution themselves. So they have to have very strong balance sheets, which of course Moderna has. But look at this, revenue is only $100 million. This is a very small company, very much betting on that COVID-19 vaccine. And when you look at some of these others, so we'll look at Pfizer here. It's PFE, ticker PFE for Pfizer, and you look at its 1 year chart, and it really hasn't benefited from that COVID-19 trend, the vaccine trend anyway. You go to the statistics here, it's a $208 billion company. So obviously much larger. I'm in an order of many times larger than Moderna. But you look at these price to sales, 4.2 times price to sales for that stock. Okay. And that's right around where it was last year before all this happened. So you've got a company that is probably first on the timeline for a vaccine development, for a vaccine approval, that's trading no higher than it was last year. Okay. Now you go down here, it's a $49 billion in annual revenue. You've got, the balance sheet doesn't quite look quite as good, but for a $200 billion company, they can have more debt because they've got that $50 billion annual revenue, that cash flow, that debt doesn't worry them. All right. But they've still got $11.4 billion of balance sheet cash. So definitely the financial flexibility and the survivability that we want to see in that. Not just it's not just the fundamentals that I'm looking at in these stocks. That price to sales, the price to book value, that kind of thing, or the balance sheet. But also, I'm looking at this production and distribution ability of these companies, okay? Because one thing that kind of worries me is that Moderna, they just said, I think just this last week, that they could have 20 million, 20 million doses of this vaccine done by the end of the year or so, right? Ready to distribute, okay? That's honestly, that's nothing. If we're looking at needing, like I said, like 660 million doses of this thing in the U.S. alone, they just don't have the production capability. So what I'm looking at is, the size of Pfizer, of Astrazeneca. They have that huge production capabilities, that huge distribution capabilities that Moderna just can't touch. Okay, Pfizer is going to be able to put out hundreds of millions of doses very quickly of this thing, as well as a pipeline in the future, right? Another thing kind of worries me about Moderna is just their pipeline. Okay, it's a very small company. $8 billion is small for a biotech, right? And what are they going to do after this? Okay, I think, and we'll talk about some of the trading ideas we've got in these vaccine stocks in a little bit. I think there is some upside left in it, especially when we do get data from phase 3 data and then approval. But a year from now, when most of the doses are out, when all these companies are rushing in, getting their vaccines approved and distributed, then what? Does Moderna have the pipeline to have more blockbuster drugs like this? And I just don't know that they do. It's such a new and smaller company. Whereas Pfizer, it's already doing $50 billion a year in sales. So definitely has that pipeline, the future pipeline. This is just a little icing on the cake for them. So, I would definitely prefer Pfizer and AstraZeneca in this. Like I said, I still think you can make some money on Moderna shares, but it's all in how you play these. Okay, I do think whoever gets first to phase 3 data and approval going to get a big jump in the share price, obviously, and the other ones are probably going to come down a little bit. Okay, so let's say hypothetically Pfizer comes out in October with their data. Their data is approved on an emergency basis quickly, and you're going to see Moderna and AstraZeneca stock shares fall a little bit. Now, that doesn't mean these other stocks are dead, though. I think you're going to get a rush to judgment by a lot of retail investors, a lot of investors saying, oh, well, shit, Pfizer's out. Moderna's dead. Moderna, they've spent all this money, going through phase trials, and now they've got a product that they can't sell. Well, no, like we saw, we're going to need 660 million doses of this in the U.S. alone, billions of doses in the world. These other companies are still very much in the running to get their vaccines out and, be blockbuster status there. So I think, one of the trading strategies you can use if you're wanting to trade. If you're just looking for a good long-term bet, I would go with Pfizer. Okay, they got a great pipeline. Like I said, they're gonna take advantage of this and make some great sales on this vaccine. So great long-term bet, Pfizer, maybe AstraZeneca. But if you're looking for trading strategies, I would say, okay, watch for some of these stocks to go down when somebody is approved, and pick up some of those, because then they're going to get their approval, and people are going to rush back into those companies. What I will say though is, towards spring, summer of next year, when there are a lot of companies that have their approval for their vaccines, they're distributing them, a lot of this is going to die down. That's when I would definitely start rethinking your investment in, Moderna, maybe some of these smaller biotechs that might not have that pipeline set up for what comes next. Okay, so definitely an opportunity to pick up some shares of some of these stocks after they fall, when competitors are approved, but then be watching for for after that. What else? Another interesting strategy that I was looking at and talking about with some old friends is when a vaccine is approved and on phase 3 data being made public, there is a good chance that we get a tech sell-off. Okay, a lot of these stocks, these Zoom, a lot of the stocks that have benefited from that stay-at-home environment are going to fall. Not necessarily because their fundamentals are going to be all that bad afterwards, but it's just the sentiment. Okay, sentiment is very important from month to month when you're investing. If you're long-term investing, sentiment doesn't mean anything, right? Because it's just the fundamentals, just the company growth. But sentiment is very much very, very important from month to month. So I think you're going to get a lot of retail investors, a lot of even larger hedge fund and larger investors, institutionals that look at these tech stocks. They're overbid. They're expensive right now. If there's a vaccine out there, people are going to start going outside again, and tech is going to get sold off. And of course, that's going to hurt market sentiment, because tech stocks right now are about 25-30% of the S&P 500 index. So about a third of the market of the index is going to be falling, and I think it's going to be very hard for the index, for the rest of the stocks to support prices. So I do think you could have a tough market here in the next few months, especially as those phase 3 data and the approval comes out. Again, though, it could be an opportunity, right? If some of these work from home and remote worker themes, that think Amazon, some of these other tech stocks that have benefited. Fastly is one of the Fastly and Zscaler is one that we've been highlighting on the channel. As these come down, they still have very good long-term futures, and I think are placed superbly to take advantage of this long-term theme. So it might be a good opportunity to wait for that tech sell-off and jump back into those names. See, so a lot of questions coming up in the chat. I want to get to those right now. So again, if I didn't see your question earlier, please ask it again. Make sure you use a question mark there so I know it's a question, because I'm just kind of scrolling through real quick on these. And let me take another drink real quick. All right. If you don't have a question, just let me know where you're coming in from and what you're drinking. Doesn't mean you have to be drinking any kind of alcoholic beverage or anything, but certainly it makes the conversation more fun. TC Markham, Semper Fi. Hurrah. Hurrah, brother. See you there. What else we got up here? I'm going to scroll up a little bit higher. Just curious. TikTok videos. What do you think about NEO? So Sakib wants to know about NEO. Haven't really looked at it a whole lot lately. There's a lot of sentiment in here, and or a lot of enthusiasm, I'll call it, okay? And I always have trouble with those enthusiasm stocks, right? These stocks that they're just kind of the flavor of the month. I'm sure they've got a great future ahead of them. But they've really got no sellable product just yet. It's just, people are looking for the next Tesla. So, I always have a problem investing in these next big things, right? Especially at the height of a bull market, or at the height of valuations like they are now. If this was in I won't say March, because I think that was a very, very different time compared to most recessions or most bear markets. But if this was a bear market and you had a tech stock that was taken off and was very much talked about and all that kind of thing, I'd say go for it, because it doesn't have that market sentiment boosting the shares as well. Right now, though, with a lot of these stocks, you've got Nikola, you've got NEO, you've got even Tesla to an extent, although Tesla is obviously much more mature in that theme. But you've got not only the hype and the enthusiasm for that specific company, but you've also got the hype and the enthusiasm for the market, for tech shares, pushing them higher. So valuations are very stretched in a lot of these tech names. Like I said, I think you can wait for a sell-off to take advantage of some of the lower prices in some of these darlings, these tech names, and that kind of thing. What do we got? No bow tie on the weekend. Nope, no bow tie on the weekend. Hey, I did dress up a little bit. Usually just wearing a t-shirt on the weekend, but the weekend, the live chats give me an opportunity to reach out to you in the community, talk face to face with you, and have a beer with you. So, and I guarantee you, at one point in this live stream, we will be serenaded by mariachis outside. Okay, so be waiting for that. With the lockdown here in Colombia, all the mariachis are out of work, so they're going neighborhood to neighborhood, shouting up with loudspeakers, their music, Saturdays, Sundays, and expect you to throw money down at them or send them a check in their bank account. Kind of annoying, but I can't blame them. If I was out of work and needed to do something, but so I guarantee you at some point we will have mariachis outside. We'll be able to hear that, and I'm sure YouTube will penalize me for pirating some kind of Colombian mariachi music. What do you think about the SPACs? So these blank check companies. Great question, Serge A. Great question. It's very much in the news right now, so I wanted to talk about this. These special purpose companies that are setting up, also called blank check companies, right? And I don't like them. They're very scary. They're almost like a lot of what we saw in 2006, 2008, where it was the financial engineering around a lot of these mortgage investments, right? That were very opaque. You didn't know what was in them, but people were investing in them anyway. And it's a lot of what I see with these special purpose investment companies. And just the fact that they're called blank check, you're basically giving someone a blank check to do whatever they want with your money. Some of them aren't quite as bad. If you invest in one, you look at one, and they've actually got a formalized strategy of what they're going to do with that money, who they're going to invest in. So if you don't know, basically these are companies that are being set up, going public in the market for pretty much the explicit strategy of acquiring another company, so they don't have to go through a lot of the regulatory and a lot of the regulatory stuff that comes with going IPO, right? A company can go IPO, issue shares in the market, get investors and everything, and then they use that money that they raised to buy another company, a startup or whatever, and basically now that company is public. That company has shares in it. They'll change their name, that kind of thing. So it's kind of a sneaky way to get around regulations and that kind of thing. Not necessarily bad, but the regulations are there for a reason. So sometimes you gotta question a lot of these companies that are using these. But like I said, some of these are explicit in their prospectus what they're going to buy, what companies they're planning on buying with this money. Others are just that blank check. Others you have no idea what they're going to buy, what strategy they're going to use, and I have a problem with that. I have a problem blindly trusting my money to even some of these larger hedge fund investors. Especially with all the hype and all the interest in these special purpose companies. Okay, again, if there wasn't so much hype in the market around it, then I might say it's not too bad of an idea if you trust the investment manager. But it was kind of like the token, the Bitcoin token, IPOs a couple of years ago. There was just so much hype. Everybody and their brother was coming out with a token IPO. And it didn't matter if they had a business plan or a business model or anything set up. They were just raking in millions and millions of dollars because of all the hype behind these. So that kind of scares me about those SPACs. What else do we have? Okay, loaded up on Melly, Google, Amazon. You think about Shell. Okay, for the so James wants to know about Shell, and I'm actually going to use that into a broader conversation on energy stocks, right? The integrated energy stocks, the larger ones. And I want to find you a chart that I've had in the in the hopefully I can find it. A chart I've used in the past on energy stocks. Some of these larger these larger ones. It's in a video. I know what it is. It's in this one. So your large integrated oil companies, Shell, RDS, Chevron, Exxon, that kind of thing. One thing I think you can come in here, and here it is. So this is looking at the cost of production, break oil prices needed or break-even prices needed on oil for a lot of these large integrated companies, right? And you see the blue is break-even for 2020. The red is proposed or expected break-even 2021, I guess. And of course, you've got the 2020 prices right around $40 a barrel. I think this is a little bit older of a chart. It's around 40, so right around that blue line where they expected 2021 prices to be. But if you look at some of these, Exxon, they need a price around 75, even as high as $80 a barrel just to break even on their cost of production. You look at some of the other ones, so you look here down at the bottom, RDS is pretty well set up. Total isn't too bad. I'm actually in CVX though, Chevron. It's got one of the lowest costs of productions, so break even actually just a little bit higher than where we are right now. And I think they're going to be able to take advantage of it. What you see right now in oil production is, we're taking millions and millions of barrels a day off of the market. All the fields, a lot of the fields in the Permian Basin, there in Texas and in Pennsylvania are shutting down or going into maintenance, and it's a very reactive market, right? OPEC is taking like 10 million barrels daily off the market. And what you're going to get is you're going to get that rubber band effect, right? You're just going to, you don't start these oil fields up instantly again. So we're taking so much production off the market and it's accumulating and accumulating. I think when we do finally get back to using our cars and flying around sometime mid next year, then we could very quickly turn from a surplus of oil into a quick deficit, right? So I think there is some opportunity in these large oil companies. For those of you worried about electric vehicles and oil demand, saw some research this week by Bank of America, and they're projecting peak oil demand out to like 2030. Okay, so you still got 10 years, a decade left of increasing oil consumption to that peak demand before the trend in electric vehicles, storage, that kind of thing really starts to bring down the demand for oil. So do you want to be holding until 2030? Probably not, because of course the market is forward looking. It's going to start looking at the increase in usage for electric vehicles and for other alternative fuels. But with this idea of supply deficit coming possibly next year or the year after that, and where oil prices are right now, I think you can be in some of these stocks, some of these oil stocks, the MLPs that we talked about earlier, and do very well for the next at least 3 to 5 years even. And be doing very well. A lot of these are huge dividend names. Like I said, those MLPs pay out 8, 10, 12% dividend yields and have the cash flow to back it. These large integrated oil producers like Shell, like RDS, like Chevron, paying out 5 and 6%. And that's after some of the dividend cuts that they've had to protect cash flow. So I think you can be in some of those stocks here. What else? Gaurav wants to know, how far do you feel the market will correct? Of course, that's always the question, isn't it? Now, a couple of things I'm looking at as far as arguments for why the market is up, why it can stay up, and why it's coming down. Okay, I wanted to share this with you. Okay, so obviously, so the reason why some of the arguments for why the market is up, why we're in a bull market when there's still what 17 million people out of work, something like that, on the continued claims for unemployment. Uh, so definitely, I mean, retail nightmare out there. I think 1,700 stores are being closed down or something. It's going to be a record how many retail stores are closed down this year, right? And the bankruptcies. So it is a little odd that the economy is not looking great, and yet we're hitting up above on all-time highs for stock prices, and for certainly for valuations, very high, higher than all the way back to 2001. But some of the arguments for why stocks are so high and why they can stay higher is one, don't fight the Fed. Okay, the old saying, the Fed is pumping in. They've already pumped in something like $4 trillion into the economy with buying the bonds. They're now buying the bonds of junk-rated companies. So the Fed is a backstop. Okay, I saw. Basically, the Fed kind of controls money supply with how much bonds they buy and the money that they pay for those bonds that goes out in the economy, and that's about 5% increase a year. Okay, 5%. The amount of money currency in the system generally increases about 5% every year, right? That's kind of what the Fed manages. Over the past 4 months, it's jumped 8%. In 4 months, the amount of currency in the system has jumped 8%. Okay, so that is just unprecedented, and it's all that money's got to go somewhere. People are in their houses; they're not going out shopping and spending and stuff. So a lot of them, they're putting it in the stock market. Another thing related to that, those rates. The Fed has pretty much promised that rates are going to be pretty much zero until 2023. Okay, and what people are saying here and looking at is there are no other investments. You can buy a bond, U.S. Treasury bond, 10-year bond for 0.6%. Okay, which if even at the low inflation right now, about 1.5%. But if the Fed gets to its 2% inflation target, which it said it's willing to allow inflation to go even higher than that. But even if we get to 2% inflation, if you've got a 10-year bond paying 0.6%, you're losing money. Okay, you are losing money on that bond. So what's happening is all these companies, all these pension companies, these banks, institutional investors, retail investors, everybody with money to invest is pouring into equity investments, into stocks, because that's the only game in town. Okay, it's even worse internationally. Bonds in Germany and France and Japan have been negative yield for years now. So it's really the only game in town is U.S. stocks, as well as some stocks in other countries. So it's hard to fight the Fed when you look at some of this economic data that says stocks should not be as expensive as they are right now. The Fed's got your back, boys. So it's hard to say that the stocks are going to fall. That's the bull argument. Now the bear argument here is a little bit more nuanced. Like I said, the tech stocks have grown to about 25 or 30% of the market right now. So what happens is when we do get that sentiment shift, and like I said, I think it's going to happen when we get some news on the vaccine, then when you start seeing that, people might start shifting out of tech. And we've actually already seen that over the past month or so, where tech stocks have been slightly down or even flat at best. And when tech stocks are 30% of the market, it gets very hard when that's flat or down a little bit for the market to go up. Okay, so not only is the sentiment for tech stocks down, that's pulling down the sentiment for the overall market. Okay, so even as you see some of these hardest hit companies like your transportation, your travel and leisure come back up or do well after that vaccine news, then I think you're still going to see a market that is struggling with itself to go any higher, just because that's such a large part of the market is selling off, is having trouble. So that's part of the bear case. Another part, and this is where I'm at really with stocks. I don't need to jump into stocks at these valuations. Okay, stocks can go higher. They've been going higher since March 23rd. Okay, slight sell-off there in Labor Day or early this month, but they're pretty much at all-time highs, right? and I don't need to chase that. Okay. If you're an advisor, you're a money manager, you have to beat the market. You constantly have to be looking for that next best investment. If you're an individual investor, like I am, like most of you are out there, you don't need to beat the market all the time, right? You need to beat your goals and beat the return that you need to meet those goals. Okay. So what I mean here is, I don't have to jump into the market with new money all the time. Any money that I have to invest each month, I don't have to put that into investments if they don't look good, right? And right now, investments really don't look great. Okay, with this valuation, I think even after that vaccine, I think, like I said, I think you're going to get a good burst of sentiment for some of the pharma names, for some of the hardest hit names in travel, leisure, hotels, that kind of thing. You're going to get some good sentiment boost on those on that vaccine name. People are going to rush into them thinking everything's fine now, but they're not fine, right? We've still got 17 million, and somebody check my math there. I think it's about 17 million on the continued claims for unemployment, and it's starting to become a structural problem for the economy. Okay, we saw some news just yesterday, actually. In fact, 60% of those temporary COVID-19 layoffs are now permanent. Okay, those are permanent layoffs, permanent unemployment from the retail, from the restaurants, from other companies on these knock-on effects. And I think what you're going to see is even after a vaccine comes out, starts getting distributed, then things aren't as rosy as people think. So I think that's really kind of the next leg to drop. Okay, is the realization of how bad that the economy really is, and that's going to hit towards the end of the year, early next year. People are actually going to come back to fundamentals on this. So I think there's definitely some better prices to get. I'll tell you how I've positioned. And if you were looking in February, actually, it was like 2 days before the whole sell-off started. I posted a video on my positioning. I have, and I pretty much come back to that spot. I took advantage of a lot of the lower prices to buy back into the market, but I'm back to the point where I'm about 25% in cash, another 10% in covered calls. So basically, a lot of even my long-term stock investments that I've got, I have sold I've sold call options against them, right? So I've went into the market, I've sold someone, other investor, I've sold a call option. Another investor has bought the call option. That gives them the right to buy that stock off of me at a certain date in the future. And mine are mostly January of 2021, right? So what had happened is I've got this stock that I'm still holding. I'm still collecting dividends on those stocks, and it's selling for, we'll say, $30. Well, I've sold the call option for 35 strike price, right? So if that stock is $35 by January 2021, mid-month, or usually it's like the third Friday of the month when options expire. If it's $35 by that time, then that investor can buy that off of me for $35. If it's 35 or higher in the market, whatever, they can buy that off of me, and I get a premium. They pay me for that right to buy that. Well, but that also lowers it also lowers the risk I have in that stock because I've collected that money from that investor, that bullish investor, right? So I've got a lot of my stocks that are covered. I don't think they'll reach that strike price during for January 2021. So I've collected a premium. I still own the stock, and if stocks don't jump higher, if they don't jump higher and meet those strike prices in January, I keep the stock, I keep the money they paid me. So it's just a great way to kind of hedge your bets. If you don't want to sell your stocks, but you're not quite sure where the market's going or if it's going to go much higher from here. So yeah, I've got 25% in cash, about 10% in covered calls, which is basically cash if they don't hit those strike prices. I've got about another 15-20% in bonds and real estate stuff. So basically, I'm about 50% in cash right now, if you're including, or 50% in non-stock assets, right? Covered calls, bonds, real estate, and cash. Because the market is just it just does not jive with the economy. Okay, and even if we don't get a big sell-off on the economy, I don't need to be chasing stocks at this valuation. Okay, so I do think keep some of your stocks, the ones you have for that long-term position. Maybe maybe sell some covered calls against them to to hedge your risk a little bit, but don't feel like you need to jump in every single month. I still want you to deposit money into your investment account every month, right? Save, get in the habit of saving that money, but don't feel like you need to jump into stocks with that money. Okay, it can sit in there in cash, and hopefully earning you an interest on some of these platforms. So I was kind of a long answer to that question there. So what else we got? For vaccine stock C and K, if you have 20% loss. So I'm kind of going over some of these that I really, how about Vaxart? I really haven't looked at the stock. Maybe I can look into it and look at some of the fundamentals, but right now I've really no idea in what it's doing. I know it's high on that list for vaccine candidates. So maybe go to stockcard.io, look in the in the featured themes tab, and look at what they say about it. What else? Unemployable, love the account name, wants to know companies that are going to benefit from the distribution and administration of these, maybe apart from the vaccine companies. And it's a great question, smart question. Actually, one of the companies I've invested in, I hold shares, but I'm also looking at is CVS Pharmaceuticals, or CVS Health, I guess is what they're called now. They've got a lock on distribution. Healthcare distribution is CVS, right? For retail anyway. They've been building this over a decade, right? I think it was 2007 they bought. I want to say Caremark. Just a few years ago they bought insurance, Aetna Insurance. So basically, after drug development, they've got an in with distribution. Okay, they've got the insurance side of it. They've got the healthcare, the plan, the different plans, healthcare plans and stuff. And then they've got the retail and the pharmaceutical side of it. So they've got a lock on the distribution. I think CVS is going to do very well on this, and it's not overpriced, right? It's come down actually over the past month or so. I think it's just a great long-term stock to not only take advantage of these near-term themes with the vaccine distribution and that kind of thing, but just longer-term themes in healthcare. We're all going to be paying, heaven help us, going to be paying more, going to get to that point where we have to pay more. Not necessarily that we want to pay more, but we're all going to get to that point where we're going to be paying more for healthcare. What better way to hedge that risk and those costs is by benefiting from some of these healthcare companies, investing in some of these healthcare companies. And yeah, I love CVS for that. Somebody else brought up A. Wallen brought up McKesson, another good one. Between McKesson. There's three of them. There's really only three companies in that that middle ground pharmaceutical distribution network. So there's McKesson. There's I want to say Allianz Bernstein, but that's obviously not it. Somebody look at what are those other two the other two companies for pharmaceutical distribution. They've got 95% of the U.S. market among the three. It's McKesson and then two others. But all three, they could get some, a little bit of turbulence there, depending on which way healthcare pricing goes and any kind of regulation there. But they're large enough, they've got enough backing, and I think they're large enough to be able to set the terms of any regulation or the deals on their side and still make money. What else do we have here? What about JCPenney? JCPenney is a bankrupt company. Don't be chasing these bankrupt companies. I know a lot of people were chasing a couple of them earlier this year. But yeah, I mean, unless you do this for a living and you can get in on the debt and that kind of thing, do not be chasing the bank stocks of bankrupt companies. It is just going to be a losing trade. The retailers as a whole, there are very few retailers that I would risk right now. I'm actually bullish on Macerich, which is one of the mall operators. I think they're doing some making the hard decisions to survive. They've cut down on a lot of their malls over the last 10 years. So it's a great quality portfolio, and I think they'll do okay. But as far as retail and mall operators, I know a lot of people are in SPG, Simon Property Group, which is the largest mall operator, and it really scares me that they're buying up a lot of these stores, a lot of these assets. I think it's kind of a desperate attempt excuse me, to buy to keep these stores afloat, right? So if you don't know, Simon Property Group, largest mall operator in the U.S. And what they've been doing lately, they've been doing partnerships with other companies to buy up a lot of these retail names. These J.C. Penney. I don't think they're in the J.C. Penney partnership, but the companies like J.C. Penney that have filed bankruptcy, they're basically buying them up and to keep them alive, so they can keep that rent coming in for their malls. And I mean, that's not their business. Okay, they're going so far outside their business into now retail ownership. And I think it's just a losing trade. They're also talking with Amazon to set up warehouse and industrial rental of their malls. And people don't go to the mall to see the Amazon warehouse. Okay, that's what these anchor tenants, these J.C. Penney's and these Macy's, that's what they were for these malls, is a draw for people to come to the larger Macy's and then go to Hot Topic afterwards, right? And it just isn't going to work with Amazon in there, right? So I think it's kind of some desperate moves, probably necessary, to keep some of these malls and these companies afloat. But it really worries me about their strategy and going forward. Yes, thank you. Handsome Penguin, Cardinal, and Amerisource Bergen are the other of the three pharmaceutical distributors that have along with McKesson, that have like 95% of the market. They're kind of a middleman resource negotiator for pharmaceutical distribution. So all three of those companies will probably do very well in the vaccine distribution and that kind of thing. So what else do we have? Thoughts on DPHC? Not sure which one that is. I'd have to get back to you on that one. Nordstrom's a bad play. They have a decent online. Now Nordstrom isn't bad. Nordstrom, Macy's, some of the larger retailers. I'd still be worried about them, but I think at this point, yeah, I mean, like I said, when you get that phase 3 data on the coronavirus trials, the emergency approval, and I think it will be emergency approval by the FDA for some of these first ones, then you're going to see a lot of these cyclical retail, travel, and leisure names just jump, right? I think that would probably be the time to kind of pull back on your profits, because I think over the next year, longer term, it's going to be a little bit harder for them. But yeah, Nordstrom's, Macy's, look into them, and they're obviously kind of value plays, turnaround plays right now. But I would be watching the debt. It's going to be very hard for a lot of these companies. We did a video on zombie companies a few weeks back, that these companies, they're putting in so much debt on their balance sheet just to survive. It's going to be very hard to service that debt over the longer term. And obviously, in retail, I think the trend is not their friend. So as a trade, Nordstrom, Macy's, some of these others might be a good trade, but I would be very worried, very cautious, especially the longer term stuff. Ray Dalio is heavy into China. What are your thoughts? Ray Dalio aside, it's heavy into China. It's worrisome, obviously because on both sides of the political aisle, China has become something of a scapegoat. And I know that's probably an unpopular thing to say right now, but sometimes you got to say the unpopular stuff, right? You got to play devil's advocate. And, COVID aside, right, I don't think they could have stopped this. Obviously, nobody could have stopped this from going global and that kind of thing. They probably could have been more transparent and let researchers in to stop it, as quickly as possible. But they become a scapegoat. And I think it's going to be a scapegoat over the coming years, no matter who wins. And they're a rivalry. Okay, this is the Cold War of the 21st century, and it's going to be that way. So I would still be worried. I've still got positions in some of the larger tech ADRs, so the American depository receipts of some of those Chinese companies. You've got your companies like Alibaba, your companies that are fairly large, well established, that are Chinese companies basically. So I think you can still go into some of those, but again, with these, if I say no more than 5 or 10% of your total portfolio in any one company, with some of these, I would say no more than 3%. Okay, because there is that black swan risk that it just escalates. This whole U.S. China thing just escalates into something worse. So yeah, I mean, Ray Dalio might be able to get some inside deals and stuff on that, but I wouldn't be too heavily into it. Uh, long term, obviously, China is going to be the now right now the second largest economy, and eventually probably the first largest. So I do still like some of these large domestic plays from the companies like Alibaba. Uh, I need another drink. It's starting to get a little hoarse here. Okay, what else? BA is one of the zombie companies. Yep, Handsome Penguin asked if I think BA, so Boeing, is one of the zombie companies. I actually in that stock or in that video that we did a few weeks ago about zombie companies, Boeing was pretty much the prime example. And if you don't know, okay, Boeing or a zombie company here, folks, is just a company that is unable through their earnings, right? And different analysts take different estimates of what the earnings are. It can either be EBITDA, so earnings before interest, taxes, and depreciation. It can be operating earnings, which is what I looked at, and are they able to cover even the interest on their debt, right? So what we're seeing is that because interest rates are zero, the Fed is pretty much giving financial life support to a lot of these companies that should be allowed to go bankrupt, right? And bankrupt doesn't mean go out of business. Boeing is always going to be making planes. They're one of the only two big plane makers in the world. They're always going to make planes, but sometimes a company just needs to reset and go bankrupt. Okay. But basically, Boeing is putting on so much debt on its balance sheet. Its operating earnings, so that's earnings after paying suppliers, paying operations, all that kind of stuff, has been, is below their interest rate payments, and interest payments are about to boom higher, right? And so right now, I'm not saying Boeing can't come back out of this, maybe late next year or so, but they are going to have a very tough time. Even if they come out of this zombie status, right? They're going to have a very hard time growing those earnings with that debt on the balance sheet. So I would definitely not be investing in Boeing right now. It is a zombie company at this point, and it's going to be a very very hard ride for investors. Might not be lost money, might not file bankruptcy, but it's definitely going to be dead money. Okay. Uh, what do you think of Palantir? Okay. So good question on Palantir. So Francisco wants to know Palantir are going to be going IPO maybe this week. Probably pretty soon. And I love, it's very similar to Snowflake, which we had IPO a couple of weeks ago. Very interesting companies, and I would love to get in on these companies, but I do not like the IPO market right now, folks. I mean, these companies are coming to the IPO market as 20, 30, 40 billion-dollar companies, and there is just no room left for retail investors. Okay, it used to be a company would do an IPO, come into the market with public shares, and it was still a $1 billion company, right? It's still a small cap stock, and tons of growth left in the future of the company, tons of growth and very good returns available. Anymore, the last few years, and even more so this year, these companies have been companies for decades. They've got huge revenues already, and the growth has even slowed down a little bit. The growth rate anyway. So these companies are 10, 20, 30 billion-dollar companies by the time they come to the market. And there's just nothing left in them besides the fact, like we talked about, that the market enthusiasm, the market sentiment, the tech enthusiasm is just pushing valuations up for these. And generally, IPOs do lose money as 6 months. I think as research says, 6 months after an IPO, the average is about 5 to 6% lower. Okay. So once you get those lockup periods off, a lot of that stuff, then the IPOs end up losing money, and that's actually when is probably the best time to really jump into these shares. But yeah, I mean, this was really my job as a venture capital analyst is investing in these private companies before they went public, and we would generally try to sell the company, so get an acquirer for the companies for our portfolio investments, or have it go IPO. When it was at most $3 billion companies, $5 billion companies, trying to get the profits out of this investment. And anymore, they're just going on for so long that all the return, all the money has been sucked out, all the profit has been sucked out of these companies by the time they hit the market. So I'm not big on IPOs this year. Even though, like I said, I really do like the business model and the theme for Palantir, for Snowflake, for some of these, but I definitely wait, to watch the prices come down and maybe get a better price on those. What else? We have to pay baggage fees and whatnot. I don't even know what they're talking about, but I like it. What do you think? What else? Airbnb IPO. Another good example. I mean, I kind of like Airbnb, but definitely not right now, and definitely not as an IPO. Okay. I haven't looked at their fundamentals. Haven't looked at their sheet, their terms, so to see kind of what the fundamentals are, what they're expecting to come to market at. But I wouldn't be buying a whole lot of stock in an IPO, or especially into Airbnb IPO just yet. I think if they're going IPO right now, it's kind of seems like a smacks of desperation to me. Okay, like they need the funding to survive or something. Because why? I mean, as a tech company, I can see it. Snowflake, Palantir. This is a great time for a tech IPO. You're going to make tons of money. For Airbnb, travel leisure rental company. Why in the hell would you ever IPO right now? You're not going to get any money for your company. So I'm not sure why they're IPOing right now unless they desperately need the money to survive. So I would be worried about that. So I see a lot of individual stock ones here that FCEL. I'd have to look at that one. Farm Partners. Talked about Farm Partners. It's a farm REIT. Last year, and I liked it last year. Haven't looked at the stock in a while, but I think it's FPI is the ticker symbol. If I remember right, it's been like 6 or 7 months. But I like the theme. Obviously, farming has been hit hard. I mean, the administration has had to just plow money into that. Billions of dollars. I think the most recent one was 19 billion announced last year or last week of money that they're going to pay farmers because of the trade war, because of the pandemic and all that. So they're basically being held on life support right now. So obviously, farm prices are fairly low, and the stock probably hasn't done well. I think going forward, then it can still do well, and it's a great asset. Farmland, old Iowa boy like myself, I know farmland is a good long-term asset, and it's a unique way to invest through that REIT, through that real estate investment trust. But definitely, be looking at the fundamentals on that. IPO immediate payout. That is correct. That's what we used to call it. Chris Georgia Kalopoulos. That's what we used to call it in venture capital. Is the payout. And unfortunately, especially this last few years, it's the payout only for the early stage investors, venture capital, that kind of thing. Because retail investors, they're just coming to the market with everything, all the profits sucked out of them. Joyanta wants to ask about Lockheed Martin. I've seen a few of these, Raytheon earlier. I like them. I like the defense stocks, especially. And I want to say it's Raytheon that is splitting its elevator business, and it's going to be much more of a pure play defense business. No matter who wins in November, what administration we get up in, it's defense is going to have solid cash flows, solid business for decades. Like I said, we're getting into that 21st century Cold War with China. China's coming into its own as far as militarily, and defense spending is one of the few bipartisan spendings in Congress. So I think definitely you can look at some of these defense names: Raytheon, Lockheed Martin. Which one? I actually just put one into a dividend portfolio that is not out yet, but will be coming out pretty soon. And it's the F-35 contract they've got through 2070, right? So decades of business and cash flow in there. Joe Little, thank you for the sponsorship there. Constellation Brands is one of my favorite beer brands. Constellation, Bud, a lot of them have been hit hard, through the pandemic, which is, I mean, okay, so obviously you've got the restaurants, you got the bars closed, that's hitting their business spending, but at home drinking is doing well. And what I like about these is not only that stability in their beverage category, but they have some of them like Constellation has a kind of uh, a moonshot investment in marijuana, right? So I think can't remember which one Constellation owns, but Constellation also owns like a 35% stake in one of the larger marijuana companies, which is basically a takeover play, right? If they're staking their claim on this particular company, when marijuana gets legalized, and we actually did a video more than a month ago on marijuana and how we were getting very close into another hype cycle for marijuana. Whether it becomes kind of a longer term thing or not, the states need funding. The states are dead broke, and they're looking towards marijuana legislation, marijuana taxes to fill that gap. So I think we're coming into another hype cycle of legalization for marijuana, gonna boost a lot of these marijuana stocks. But anyway, Constellation Brands is basically staking their claim in this company, the 25-35% stake, saying we want to be in on this growth, and eventually, if this company does take off, we're just going to acquire it. We're going to buy the rest of the shares. That's what happens when these companies, when you see these 25, 35, 40% acquisitions, or 25, 35% stakes in a company. They're staking their claim. So yeah, I like Constellation too. GE. Could you talk a little bit about GE? I mean, great question. I own GE. I've actually got when it was up around $10 or $11 earlier this year. I used that covered call strategy to sell the $12 call options. I don't see it going much higher than 12 over the next year or so. So I wanted to lock in the premium that investor was willing to pay me. I like GE though. It's not an existential danger, I don't think, at this point. I think the CEO, Culp, has done a very good job of stabilizing it. It just came up hard over the last month. It was down as low as about $6 a share, and then the Culp, the CEO, does an amazing, excellent job at managing those expectations. Wouldn't commit to positive free cash flows during the last earnings announcement. And that's what sent the shares down. I think it was down like 8% on the earnings announcement. Wouldn't commit to it, but he was holding it in his back pocket, obviously, because just this last couple of weeks, last week or so, he did commit to positive free cash flow by the end of this year. I think it was actually in the third quarter that he was talking about. So obviously that sent the shares skyrocketing. They're now around $7 a share, which I still think is a good price for shares right now in GE. Like I said, I own them. I have them covered at $12. That probably won't make it there by January when the covered call position goes out. So I'll probably wait till it's around $9-10 a share again, and then sell some more covered calls against that position, because I think especially with airlines was their golden segment, right? The power segment was losing money, but airlines was making money, and obviously that's going to be hard for the next year. So I don't think they go up to $12-15, but I do think it's a decent long-term investment in that. Flooring, thank you for that sponsorship. What do you think is the best book for someone that would like to start investing but doesn't know anything about it? A best book for starting investing. Now, I mean, okay, the obvious answer is always Buffett's, or the Buffett's book, The Intelligent Investor, Graham's book, right? But I think actually, you know what? I think that's a little too detailed for a lot of people. I want to say Jack Bogle's book is really good and really gives you a beginner's guide to investing. So we'll bring this up real quick to show you. I think it's Boglehead's investing book. We've got the little book of common sense investing right there. And I think that's actually So you've got the Little Book of Common Sense Investing is a very good book, and I mean it's going to give you that basic knowledge of ETFs, of individual stocks, that kind of thing. It's going to start you off. I think there's also one called Boggleheads. There you go, Boggleheads. It's also another very good one to read if you're just starting out investing. Okay, what this is going to do, this is going to give you a very simplified approach to investing. Okay, with the Boggleheads, I think they basically plan everything around just 3 funds. Okay, so I think what this does is gets you started with the very basic, the most simple concepts. And then from there, once you've got that portfolio, a very diversified portfolio around 3 to maybe 5 funds, then you can start reading something like the Intelligent Investor, and learn a little bit more about that stock picking. Okay, so the Intelligent Investor is very much more of a stock picking analysis type of book, whereas Boggleheads and that is much more of a basic, simplified investing approach. I think it's a great strategy to start off with that simple approach and then just build from there. So great question though. You can start in a wheel. Try the Bud Nitro. I want you. If you don't know, I live here in Medellin, Colombia. Right, think way far south Colombia. Been here since I did some business consulting around the free trade agreement in 2006. The wife and son and I moved back here in 2013, and actually getting ready to move back to the United States. But we're here, and Bud is pretty much the only good beer anyway that you get down here. You get a lot of Colombian brands that taste like piss, but Bud is really the only one that we get. So but when I get back to the U.S., then definitely Bud Nitro. Gonna have to try that. Okay, what else we got? Any comment on long-term investment in telecom stocks like AT&T? I think telecom still has some good upside potential. I haven't actually looked at the sector since our sector investing series back in November, December, where I covered each sector in a video and really talked about that. Tech or telecom has the 5G and the upgrade cycles coming. It's already invested so much money in the infrastructure that really held a lot of those companies back, the returns back, because they were reinvesting so much into the infrastructure. They've got that done. Now they're ready to reap the benefits of that, and I think they'll be doing pretty well. AT&T scares me a little bit just because of the breadth of their business model. They are in so much stuff within, with DirecTV, with the cable and all that other stuff. I would much rather go into a pure play telecom right now, whether it's through maybe Verizon or some of the other ones. I would much rather be pure play rather than a company that's trying to take on so much with that. In Medellin, you must be a king there. I would be a king if I ever went outside. I spend probably 60, 70 hours working. So I'm in my bubble in the house with my family here. And we actually just opened up just recently. Colombian drug lord with a bow tie. Not quite, but almost. What else do we have? Self-driving vehicles. Antonio wants to know about self-driving vehicles. Again, I think that's in one of those themes that is a great long-term theme, long-term idea. But right now, the money and the enthusiasm and the hype is so far into that. You've got Nikola. I was actually in Nikola, sold out of the position there for about 20% gain on that. But I got out because not necessarily just because of that short seller report, which a lot of those times those are just hatchet jobs, just trying to bank on that initial news and that initial fall. But also some commentary from some respected analysts that think that there's going to be some trouble with the CEO and with that company. But the shares are so much higher just for any self-driving vehicle company. I am actually in some of the related themes. Okay, so I think if you're investing in self-driving vehicles, I think you need to be in the companies that are making the most progress, but are in another line of business as well. So perfect example, Uber. Okay, Uber has another business, totally separate. They're doing okay. They're coming back. I think it's a great value stock. I actually owned shares of Uber since late last year, I believe what it was. But they've also got that moonshot investment in self-driving. Okay, so when self-driving becomes a an actual thing, a more modern or more more reliable form, then Uber is going to be there and they're going to take advantage of that and they're going to make it. So I think yeah, you look at if you're looking at self-driving instead of maybe some of these pure play companies like well, I think Nickel is actually electric, but Neo is, I think, isn't Neo the truck? I think Neo is the self-driving truck one. I would much rather be in a company that's got another business aside and has got that moonshot investment in that. Uh, where else do we see? Seems like Nicholas seems to be going to Workhorse. What is your Pacific Gold Fund? Yeah, some of these, the companies I haven't looked at for a while, so I can't really give you a recommendation just on the cuff here. I haven't looked at Wendy's, some of these other Costco, Aldi's. I haven't looked at them for a while. Costco is nice. I think they've got that a lower market and cost advantage. So you can definitely look at that. Wendy's and Aldi's and Costco are pretty much in the same boat, but Wendy's is obviously a totally different business model. Where are you avoiding talking about Tesla lately? I never talk about Tesla. I think you're probably confusing me with with Jeremy over at Financial Education. He's always talking about Tesla, but I rarely talk about Tesla on the live streams or in the videos. I don't think I've ever talked about Tesla in the videos themselves, but Tesla, it's I don't know. Tesla kind of reminds me of Amazon in the sense that it's always overpriced and yet they always seem to be doing well. Tesla, though, I just don't see it. Tesla, there has to be a point, honestly, there has to be a point where Tesla's valuation comes down to just another car maker, right? Because you've got all these other car makers building electric vehicles, right? You've got Tesla that is ramping up production to really compete with these other vehicles or these other vehicle makers, these auto manufacturers, and to become just another auto manufacturer. So yeah, they've got a great brand. They've got obviously got first movers advantage and some great IP on this tech on the electric vehicles. But honestly, it is another automaker, and eventually that PE ratio, that price to sales, that price to book value of that company has got to start coming down to the to what these other auto manufacturers are trading for. So if you can call it, if you can get in on a low and get out on a high and make those trades, then that's great. There's lots of money to be made, obviously, over the last year in a stock like that. But over the long term, you better be know how to time it, because there's going to be a slow bleed as the valuation multiples come down on a stock like that. So it's very hard to try that. But like I said, Amazon's been doing it for more than a decade, so there's definitely time for it. Kraft Heinz. Mikhail wants to know about Kraft Heinz, and actually I just added Kraft Heinz to a dividend portfolio that we'll be talking about. They finally came out with a strategic plan. Okay, and more than just talking about Kraft Heinz, I want you to get this this next part. Anytime you see an IPO from a private equity company, right, and that's what happened to Kraft Heinz. Okay, private equity took them off the market, took them private, and then they came back about 5 years ago. That private equity company, and in fact, Warren Buffett was part of that deal. A couple of private equity companies had bought them, and then brought them public again. Be extremely cautious whenever you see that happen, okay? Because what happens is the standard, the operating procedure, right? What these private equity companies do, they'll buy a company in trouble, think they can turn it around and all that. They'll buy a company in trouble. They will load that. They will load that thing up with debt. I almost cursed there. Whatever. They will load it up with debt. Make some management changes, maybe turn it around a little bit, stabilize it at least, and then turn it public. Well, the problem is, and what happened to Kraft Heinz, and nearly always happens with these private equity IPOs, is they've just got so much debt on the balance sheet that it just saps all the financial flexibility out of that business, out of that company. And like we've seen with Kraft Heinz, it's taken 5 years for them to be able to manage that debt, get back to a point where they can have some flexibility and some competitive advantage and stuff like that. So I do like Kraft Heinz right now. I think there is value in the stock, and obviously the valuation multiples are very low. The dividend is great, and they've got some great products. They've got some great brands, but they've just been weighed by that debt for so long. So more than a recommendation for Kraft Heinz is a recommendation to always be hesitant whenever you see an IPO of a company, no matter how big, no matter how well known or how established, that is doing an IPO from private equity. Okay. It's kind of like basically the same thing as we've been talking about with the IPOs lately. Okay, all the profit is just sucked out of those companies by the time they come to IPO. That there's some real problems with investors, at least over the next 3 to 5 years, often. Okay, well, okay, I'm gonna finish this beer and take the rest of the day. We've been at this for about an hour and a half. I thank everybody for being here. Like I said, this is kind of the highlight of my week when I can do these live streams and just kind of talk with you. And I'm going to try doing these beer money live conversations more often because I get to basically just share a beer with my nation out there. So thank you again, and I will see you next week.